Hello, this is not Alan Gassman, and I'm here today to basically say if you were planning to see a good presentation today, you're finally in luck because Gassman isn't here. Today's presentation is with Lori Valentine. Lori, Alan will come here soon to actually start the presentation, but I had a question.
Yes.
What does it take for me to become a 501c3 puppet?
Well, you have to have a charitable purpose, and very likely as an individual, you're not going to have directly, it would, so that's the main, to be a 501c3, you have to have a charitable purpose. And then you have to apply to the IRS for tax exempt status and the determination of, do you have that charitable purpose?
I like chocolate treats. Is that a charitable purpose?
No, not a charitable purpose. No, education, affordable housing, things like that are charitable purposes.
I talked to a dolphin. Is that a charitable purpose?
Not a charitable purpose. No.
Not a charitable purpose.
Oh, porpoise. If you're being kind and doing that, sure. We'll argue charitable porpoise on that, right?
All right. Well, I hope your presentation today goes swimmingly. Thank you.
Thanks very much. Appreciate it.
All right, Alan, she's ready. Okay. Hello, everybody. Welcome to this afternoon's or this morning's presentation. I'm here with my friend, Lori Valentine. Lori gets an A+ in enthusiasm, an A+ in knowledge, and an A+ in dedication to charitable purposes. Lori is involved with a number of charities, but most notably the Tampa Foundation, which she'll be telling you about. If you have questions during this presentation, please go to the question module there, click on the upside down pyramid, type in your question, and we will make sure that it is answered. You can address the easy questions to me and the difficult questions to Lori. Please note that this presentation does not qualify for continuing education credit, but what we're here to do is to give you some really good, very useful information on how you can be involved in charitable endeavors. So Lori, we're starting a couple minutes late here, so I just want to let you get straight into this.
Very good. Okay. Very good. Okay. Well, Alan first asked me to kind of say why in the world would because that's what he asked me personally a few months ago at something that we were both attending. Why would a tax attorney consider working for or with a community foundation? So next slide, to make sure we are all on the same page about what is a community foundation. A community foundation is a 501c3 public charity, tax exempt, of course. It has a independent governing body, either a board of directors or board of trustees, generally made up of business leaders, entrepreneurs, folks with real estate expertise, investment expertise, located in the community that the particular community foundation serves. It's publicly supported by many unrelated donors. Our donor list is very, very large, several thousands of separate donors. We have about over 1,300 separate charitable funds that have been established. Some donors create more than one. A goal of a community foundation is to build permanent component funds, growing the size. I have been here 2 years, and when I got here, we had just started a new fiscal year that was June 30th, 2022, and we closed that year at about $355 million. We are now at $860 million of assets under management, thanks to some very significant estate gifts that have come in and some other major gifts. So anyway, but that's the goal. The reason is the more assets we have, the more can be deployed out to support the community. Now, Community Foundation Tampa Bay and most don't restrict a donor's giving to the geographic area that is served by the Community Foundation. And for Community Foundation Tampa Bay, that is Hillsborough, Pinellas, Pasco, Hernando, and Citrus counties. And we focus on that area for the money over which we have discretion to grant out. But a donor can create a fund with us and support any public charity anywhere in the United States. And I have worked in my just 2 years here with a lot of donors that are setting up funds that will benefit organizations or folks like scholarship funds, but students in other areas of the country. Broad-based charitable interests, you'll see that in a minute, but you name the charitable focus that someone might have, we can help them, figure out how to do that. We also, and most community foundations, many of them, certainly the larger ones, serve as in a leadership role in the community. We have initiatives in the college access area, in Thrive by 5, which is getting children ready for kindergarten, digital inclusion, disaster relief. So we have a number of initiatives that we're involved in. We're actually exploring right now affordable housing and how to do that. But how we might support and get more directly involved with that. Next slide, Alan. So basically, a community foundation, and what I get to do is matchmake and help donors figure out, I've got this area of charitable interest, what might be organizations that support that and are doing good work in that area, and also matchmaking from the point of view of what kind of giving vehicle or vehicles should I consider. I work with the donor and their advisors to kind of accomplish that particular donor's goals. So the next slide kind of shows you the various options that first we'll then focus on how much involvement does the donor want. Unrestricted fund would be funds that we have where Community Foundation has the decision making regarding what organizations will benefit. And unrestricted means totally anything, could be any type of charitable interest. The next one, a little bit more involvement in that the donor selects when they create the field of interest fund. They say, I want my fund to support, and it could be just one charitable interest like the environment, early childhood education, veterans, or it could be several different ones. But then each year when we're going through our competitive grant process, we're looking at the funds that, and we have competitive grant applications for needs in the veteran space or in the environmental space. We're looking at seeing the funds that donors have created in that space and granting out of those funds. Designated fund, more donor involvement in that the donor picks the exact organizations, nonprofit organizations that will benefit from the annual grant out of their fund. Designated can also be so designated endowment for specific, the grant comes out to specific organization or organizations, or designated also would apply to our scholarship funds. And then donor advised fund, donor has significant involvement. The gift is made to the Community Foundation, but they reserve the right to advise what charities should be supported with their fund, both the principal and income of that. And then supporting organizations is an option in many community foundations, and it's not a private foundation, but it has a little bit more of the characteristics of that than even a donor advised fund. So next slide. The focus at any nonprofit, definitely a community foundation, is always donor impact, what the donor wants to do, what are the donor's philanthropic goals, and once again, as I mentioned, what kind of fund, might help them accomplish those goals. At Community Foundation Tampa Bay, we have donor advised funds, family foundations. That's not a private foundation. It's actually a donor advised fund on steroids, as one of my colleagues calls it. It's going to start out with a larger amount than a donor advised fund. Our minimum for donor advised fund is 10,000. Family foundations, it's 100,000 or more. The donor says, I want to be able to be an advisor, but I want to name several successive generations. With our donor advised fund, it's just a successive generation of advisors. We also then get involved with the family if they want to have a family meeting once a year to kind of deploy assets and make decisions together. We also do family, kind of gift giving and helping family develop their mission statement, figure out their values and how, once again, they can give to do that. State gifts, we have a legacy fund. Basically, it's an unfunded agreement that says, when I die, if you receive something from me, Community Foundation, here is how I want you to set it up. And it could be any of these kinds of funds, even a legacy donor advised fund. Scholarship funds, obviously, and it can be where a committee at Community Foundation makes the selection each year. A lot of times a donor could be one of the selection committee or a donor designee, or it can be for, a college or university and allowing them with the donors' eligibility requirements to do the selecting. Designated endowments, I've already mentioned, is for specific organizations, field of interest funds for a field or fields of charitable interest. And then we also do charitable gift annuities. Now in my second section, I'm going to also talk about other charitable remainder trusts, charitable lead trusts, which are also ways to give. We no longer serve as trustee of charitable remainder trusts. We talk to a lot of people, and you'll see some examples in a minute of some charitable remainder trusts that will be the ultimate beneficiary of, but we don't serve as trustee of that. And as you can see, any kind of charitable interest can be supported through a fund at Community Foundation Tampa Bay. Next slide.
So Lori, before we go to the next slide.
Sure. Yeah.
So a client comes to me and says, Alan, I've got $2 million of appreciated Apple stock.
Mm-hmm.
I know I want to do at least $2 million of charity between now and my death.
Mm-hmm.
Should I go to Lori and give her that appreciated stock, get my tax deduction this year, and have her title it in what she calls a family foundation, or should I set up my own family foundation? Can you give us the 30-foot view of what the pros and cons are?
Well, yeah, and I'm going to get into that, but absolutely. The biggest pro is for setting up a family foundation donor advised fund is it's very quick. It is a component fund of the community foundation. So there is no requirement, as there would be with a private foundation, that you have to get the tax exempt determination from the IRS. There's no separate Form 990 that has to be filed every year with a donor advised fund. That fund is a component fund of the community foundation. So it's just part of our assets that we report on our 990. And two other huge ones is if you're, now, Apple stock would not be the case, but if there was an interest in a business that they were thinking about gifting, much, much better to do a donor advised fund because you're going to get and use the fair market value of that asset versus if you give it to a private foundation, it's cost basis. And finally, there's no timetable on when money has to go out of a donor advised fund. There's no 5% annual distribution requirement as there is with so you can put the money in now when it works for you for tax purposes and let it grow and then grant it out as you decide any amounts. And as I said, principal and income, whenever you want to do it, but no set maximum or minimum distribution amount.
Great. And then what's the cost imposed upon the family foundation by the community foundation so you can pay your overhead?
Yeah, well, both the family foundation and donor advised fund, the first $2.5 million hang on, you're asking me, 2 million, is at 85 basis points is our administrative fee. If our pools, if the donor says, I'm going to have you all do the investing, that it's another 9 basis points. The donor does have the option with us to recommend that we engage their investment management advisor, and then it would be whatever that advisor charges as fees. The account is set up in our name at the advisor, but once again, it's their chosen, many times long-term advisor continues to, invest it per our investment policy statement.
Beautiful. Sorry if I burnished ahead, but I thought that would be an entry.
Sure. So why would a tax attorney want to work for the Community Foundation? Well, it is very impactful work. This is my second time in the charitable space. It wasn't technically a community foundation I worked with for 23 years while I lived in Kentucky, but from the point of view of we were receiving gifts to create funds for the benefit of other organizations, and it's fantastic. And you're not limited to you're helping the donor support their area of charitable interest. So, you're focused on local needs and how to, help folks support those local needs. Very diverse experience. You're all over the place, from a very basic donor advised fund funded with cash or some publicly traded stock, up to, some other type of giving vehicle that's funded with an interest in a business or real estate or whatever. Number 3, very, very important for me at least, and it definitely was when I was with the nonprofit in Kentucky, because I had a son who had just finished first grade and a husband in school. So the fact that I was not working 60 hours, probably Alan works 90 hours a week in a law firm setting, was really, really nice. And, just that work-life balance. You've got one client, so no timesheets, no billing, all those things that, at least for me, are not very fun. So I've done the private practice twice, but this is work-life balance. So next slide for a few more reasons. Leadership and influence. You have the opportunity in some cases to serve out in community in various leadership roles. We have some of our staff that are on Chamber of Commerce committees and other things in the community to help, with having ear to ground what's going on in the community and helping to shape that. Obviously, reputation and recognition, can be enhanced by that. And then definitely number 6, especially in the community foundation space, is continuously learning, because there's some different kind of laws with community foundations than just other nonprofits. So I've really, been on a learning. And then every single kind of complex gift I've worked on, I've had to do some learning on that, even though I know and have done a lot of charitable gift planning over my 42 years. But I love that. I love that I'm always learning. Right now, I'm focused on impact investment funds and housing trust funds. So that's my newest area of learning just in the last month or so. But it's always learning, which I just love.
Nice.
Mm-hmm. And I should say, work for could be literally on the staff, or it could be your outside counsel for the community foundation. And, we rely, while I'm in-house and I kind of get some things started, we rely a lot on our outside counsel. And so you get a lot of those same benefits with, being outside counsel. Then working with this, I'm talking, and kind of Alan has teed a lot of it up, is why would a tax attorney on behalf of a client reach out to the community foundation? Well, once again, that donor advised fund. Now, yes, there's a lot of commercial donor advised funds that can do the timing of gift versus philanthropic support idea, but they do not have and will not be helping your clients figure out, okay, these are my values, these are my areas of charitable interest, and if the client needs it, what organizations I might want to consider supporting. that concierge level of service. We're there. We are, provide customized fund agreements, planning. We do know the charitable giving, tax planning aspects, and so we can be there. While many of you all would know much more probably than I do about charitable tax planning, many advisors don't. And so we're there to help and as a resource, not to provide legal advice, but as a resource. A lot of fund holders like to connect, and we have different kinds of events that they could connect on with that. And so that might be something that your clients might want. Next slide.
Let me just mention another.
Oh, sure.
A donor advised fund, Schwab, Fidelity, Vanguard. You put the asset in there. The community foundation is able to accept a much broader type of asset, like stock in your company or your building, something like that. But then secondly, all Vanguard lets you do is which charity would you like to give it to? And you can only give it to public charities. Whereas with a community foundation, you could help somebody who's not your friend, you don't know them, but you heard about a problem or you heard about an issue. Can you give a couple of examples of maybe something you've been involved with where?
Well, a donor advised fund does have to go to a public charity, and cannot be an individual specifically benefited, but we do have donors that say, I want to help this person, that's involved with a missions organization. And as long as the giving in makes it clear that the missions organization has the final say on who benefits, you can say, and it would be great if you would consider benefiting Margaret Smith's missionary efforts or whatever, but it's still public charity always for money to go out of a donor advised fund, and there can be no benefit to a particular individual, and nor can you get benefits. So giving money out of your donor advised fund for the fundraiser where you're going to get some tickets to the fundraising event, can't do that out of a donor advised fund.
Right. Okay, very good.
Yeah. And then greater charitable impact, our admin fees, yes, it's a fee that hits the account, but it is supporting our work, our staff, what we're doing out in the community. So you're expanding beyond what you're giving out of your fund, the charitable impact. As we've talked about quite a bit already, that complex estate planning, we can receive gifts, we can do some complex things that very likely a commercial DAF would not be able to do. I'm going to give you a couple examples there. And then for the legacy piece of things, when you're gone, when your client, I should say, is gone, the fact that you have a reliable, we've been around, at least Community Foundation Tampa Bay has been around since 1990. We've got a track record to make sure donor intent continues to be carried out. I was on the phone with a nonprofit who's received a new estate gift, and they'll be adding it because it's directed to the endowment fund, that nonprofit. And there was a question about, donor intent. So we're very, very hardcore about that and making sure so your clients can be assured we're going to make sure that the directions they give us are going to be carried out to the T. Then next. So
Well, actually, if anyone would like to be, if you'd like to be on Lori's mailing list, just go to the questions panel and just type in yes or why or I want, anything you like, just to let us know if you'd like to be on Lori's mailing list. Sorry for the interruption.
No, it's fine. It's fine. So I'm just going to quickly run through some case studies just to show you kind of the, fun things I've gotten to be involved in, I guess we could say, over the last 2 years since I came to the Community Foundation Tampa Bay. So the first one is a really exciting one that I came in. There'd been already a little bit of discussion, but I kind of helped working with our outside counsel firm, definitely. But we have a donor. He already has a significant family foundation donor advised fund, had started doing some estate planning with his attorneys a couple of years ago and found out that the way he owns his entities, it was not going to qualify for any estate tax deferral, and the estate tax bill was going to be huge. So working with his advisors, transferred all of those interests to a triple LP, and he owns both the general partnership and limited partnership in different entities. But at his death, he is gifting both interests to Community Foundation as additions to his family foundation fund. He's named his wife and 2 adult children to be successor advisors to continue on that operation. Obviously, his goals, one of the big ones was eliminating the majority of his estate tax. And just need to mention here, he involved his family in this decision-making and planning. So they're not going to be shocked and filing a lawsuit, you know, about undue influence. I mean, but anyway, so eliminating majority of his estate tax through the charitable estate tax deduction at his death, assure maximum value. And he wants to assure maximum charitable impact from this very significant gift. And he's had an entity assisting with the management of all of these entities for many years. We are not bound by that, but he would like, and it makes sense to have that same manager assisting us. So next slide for kind of the details of what we did.
So the main theme here was, instead of leaving 40% of all these assets to the IRS
yes,
and 60% to my family, I'll leave these particular assets to the foundation. The IRS will get nothing, and my family will make sure that it's properly administered for charity.
Exactly. And the family has received gifts during life. You know, he's going to have used up all of his exemption and all that. So yeah, they're not like destitute or anything like that, but they're definitely on board with this. Yes.
Would it be common for a very charitable person to say, I think it's enough for my children to have 10 million each and the rest to charity? Is that would 10 million be a rule of thumb right now, or 5 million, or what?
I think it's a personal decision. Yeah, I mean, it's just looking at total wealth. And then, so solution is that we and this donor executed a gift agreement under which donor has committed to making this gift of the general partnership and limited partnership interest in the triple LP to his DAF. And we've agreed to continue active operations for 10 years after the donor's death, and then a 5-year liquidation period. And then, you know, in the gift agreement, there's commitment that Community Foundation will receive what we need to cover tax liabilities, our admin fees, expenses such as, you know, extra audit expense, all of that kind of thing. And then in later years, as we get closer to the, you know, as that 10-year timeline goes along, we'll receive more and more percentages of the net cash flow out. So that will be growing and then available to deploy out to, you know, charitable entities. So
okay, and there's no tax law that says it has to be 10 years. This is just where the emotional and business decision was made. When I die, please don't sell all my stuff right away.
Yes, you know, there's no tax, right? There is no tax rule. It is just kind of what he thought, based on his, and he's, you know, very knowledgeable. It's mostly real estate entities. You know, he feels like that will result in the biggest charitable impact, the most dollars. Yeah. And then, you know, just this was a family, 40-year family-owned business. They were in process to offer the business and get out, you know, sell the business entirely. They wanted to tie. They're very religious, and so they came to us. All 7 created their own donor advised fund, made a gift of 10% of their both voting and non-voting stock. We all came to the table. They obviously goals were support national, local, and national nonprofits, receive a federal income tax deduction, and avoid at least a portion of their long-term gain, because obviously owning a business for 40 years, there's lots of growth in its value. So next slide is each of them created a donor advised fund and gifted 10% of their particular interests to us. We all came to the table. The assets were sold. Now, normally we're not a pass-through, meaning gift comes in and it's immediately deployed, but we agreed to that. We have a fee structure for that kind of thing because they wanted to immediately benefit. But 94 different charities amongst the 7 family members receive benefits out of those 7 donor advised funds. So just significant impact. And then next. And some of this, yeah. So
well, let me ask something on this.
Sure.
When they donated the stock, was it before there was a letter, or in general, not this transaction? Is it usually before there's a letter of intent, or just before the close? What's
right,
the?
and I should have said that well before. They had some interest, but there was no letter of intent, no commitment, nothing that would have prevented community foundations to say, nope, we're not selling. And that's the key in a gift of a business interest or a gift of investment real estate or something. You can't have it locked in with no wiggle room for the nonprofit. So right, this was well before that. They were in the very early planning stages, and their CPA, I think, had brought this to their attention, knowing that they're charitably inclined. But no, well before any letter of intent.
Okay, so just for the attendees, because a lot of tax lawyers get mixed up on this. If
Sure.
I have a $10 million business that used to be that has a basis of $1 million,
Mm-hmm.
I could sell the $10 million business and then I could give $1 million to charity.
Yep.
But I'm much better off donating 10% of the business to charity before the transaction. So
Yes.
I get both the tax deduction and there's no capital gains tax on that portion that the
Yes.
charity gets. But I have to do it. I have to do it at least before there's a binding agreement, and the IRS says you have to do it at least before you kind of knew that you were going to be able to sell it. I think the case law is very unreasonable. That Hohenfeld case that came out, I thought it was very unreasonable, but it is.
Oh, I can't even believe they thought, because I just thought they went way too far. I don't think it was unreasonable at all. They had let that go way too far. There was no option other than Fidelity having to sell. There was no wiggle room whatsoever. They held it out way too close. Well, over the line, in my opinion. So I kind of have a differing opinion about Hohenfeld than others do. But yeah, you want to just do it if you have a client thinking about selling their business, bring this idea up to them. I mean, that's the key, so that they can begin to explore it and how it might work and what kind of giving vehicle they might want to gift it into and all of those kinds of things well in advance of any kind of narrowing it down to who might be the potential buyer of that, and definitely before there's any letter of intent locking in that sale.
And then do they typically give the charity a put right to sell the stock back to the company for 10% of the value, so you don't have a valuation discount issue on your charitable deduction?
Yes, if it's not going to be sold, I don't think in the one I'm talking about, it was finished up right before I got here. I got involved with some later tax issues because there were some tax refunds and then how to, divvy those up and all that kind of thing. I don't think there was a put here on this one. I think, we said, yes, if it gets sold within, X, and that's one thing the charity's going to have to do a lot of due diligence before. They want an exit strategy, at least not absolute, but they want to know that one is potentially in the works. The charities, the triple LP gift is highly unusual. Both charities say, we want to receive it and get rid of it, either through a put back, you know, so that the corporation will buy the stock back or whatever. Mhm.
Now, Attorney Barry talks a lot about dad has low basis stock in the family company. He donates it to the community foundation. He gets a tax deduction at fair market value. Then a few years later, the kids buy it back from the foundation and they have a high basis. Now, what he doesn't say is maybe in some situations, dad gets a $10 million deduction and the kids buy it back for $5 million, or have you seen those? And what do you think is going on there?
Yeah.
Asking him, I didn't get any responses.
Yeah, Community Foundation Tampa Bay would only sell it back for full fair market value. We would not do any kind of discounting. No. So just FYI. Yeah. And then flip charitable remainder unit trust, and I'll just, when we get to the next section, I'll just skip over, but this is donor couple, very charitably inclined. They have a DAF with us. They also have a legacy fund, meaning, and when both of them, because they have no children, when both are deceased, everything is coming to us. Some is going to go outright immediately, and the rest is going to be created to create a field of interest endowment type of fund. They have owned a commercial building for years, and they were ready early last year to be out of the landlord business, but they didn't want the capital gains ding that they would have if they sold that property, and they really didn't want to give up that cash flow that they were getting from the rental of that property. So a flip charitable remainder trust, that's the one that you make the gift, and there's a provision that says until a triggering event occurs, in this case, it was going to be the sale of this real estate, all you get is the lesser of the net income earned by the unit trust assets or the unit trust amount. And then on January 1st of the year after the triggering event, in this case, the sale, it goes into a standard charitable remainder unit trust. So they transferred the property in, the charitable remainder trustee sold the real estate fairly quickly, a CRUT is tax exempt, so 100% of that net sale proceeds is available to be invested to begin to produce that cash flow and they selected a payout rate out of the unit trust when it flips to the standard that will kind of mimic the cash flow that they had been receiving. And with the unit trust, it's revalued each year, and that designated payout rate is applied to that each year's value of the unit trust. So hopefully, if it's invested well, the value of the unit trust assets are growing, and therefore the cash flow out to the donors' life income beneficiaries continues to grow.
So another way to explain that, because I know there's a lot. I know there's a lot here for the layman.
Yeah.
Another way to explain that is you could most common or very commonly it's a 20-year arrangement.
Yes.
I put $1 million worth of appreciated assets into the charitable remainder unit trust, and it's going to pay me about 11.2% of its value every year for 20 years. And what's expected to be there at the end for charity is fairly low. And normally you get a tax deduction of 10% of the value of what you put in, because you got to set it so that charity gets at least a 10% value. So if you think about it, I put $1 million in, and then if it doesn't grow, the first year I get 110,000 back. The next year I get another 110. The next year, if it grows, I get more. But yes. I can defer those payments. So while I'm working or while I'm living in a high income tax state, I can defer the payments. So I put that $1 million of Apple stock in there. The trust sells it. There's no tax until I receive payments. I don't get payments for the first 5 to 6 years. So then I've deferred those payments. So it's
if it's invested in growth versus, but yeah, well, you will, if it sells and the triggering event is the sale, then you would start getting the unit trust amount. But anyway, yeah, we have generally much more charitably inclined, so they don't do that high of a payout rate, quite honestly, and we hope that they will not, so that there is something left to come to us, quite frankly, at the end. Okay, next one, this may be the end of this one, I can't remember. Oh, private foundation, and we've already talked about this, and that's, you know, some folks have created private foundations and they get to a point where they want to do other things. The next generations aren't, they're fine to be involved with the giving out, but the administration not so much. And so that is a great way to take the private foundation assets, give it to a donor advised fund and a community foundation. There's no termination tax and all those issues you have in other circumstances with the termination of a private foundation. The family continues the joint, you know, family giving deployment, but, you know, without all the administration hassles.
Okay, so for the tax nerds,
yes,
if I have appreciated stock, I can put it in a private foundation and still get my deduction at fair market value. But as Lori said, if I have appreciated real estate or appreciated private corporate stock, I can't get the tax deduction unless it's a private operating foundation. So your clients could form a private foundation that operates, which has some, that actually does something, and get that deduction. But still, with a private operating foundation, you have a minimum distribution rule of about 4.25% of the value of the entity has to be spent every year on legitimate purposes, including distributions to charitable purposes. And with a private operating foundation, you can't really have arm's length transactions. You can loan money to it tax-free. It could employ family members to do white collar stuff, but it can't buy your corporate stock. It can't receive your business stock. So you can't be partners with it. But with a public charity, you can be. A public charity is a charity that receives generally more than 33% of its support from unrelated people who never heard of each other. Or a church, or a medical research organization, or a hospital, or a clinic that qualifies as a hospital, or a school. So some wealthy families just form their own school so that they can do all this stuff, but it sure seems easier just to call Lori. And
let another nonprofit do all that work, and you just have the joy of helping to support them. Absolutely, absolutely.
I hope I didn't cause too much confusion there, but all that stuff goes on.
And this is just, you know, the solution so I won't go there. We'll jump over to the other one because I'm running out of time and I have way too much information. So I then am going to give you some, you know, Laurie's giving guide, haha. But anyway, this is the IRS's giving guide. But you know, in these ways to give, and I'm not going to hit all of them. Alan, if you want, you're welcome to share these slides with anybody that would like them, so you have a little bit of the detail there. But we're focused on plan gifts, giving out of assets, not income, looking, you know, plan. They're looking at their entire estate and financial plan when they're thinking about this, because once again, they're giving out of assets, using tax advantaged vehicles to accomplish donors' charitable giving objectives. And the charitable benefit can be either immediate, meaning the charity is going to get something right off the bat, or it can be deferred. Maybe the donor gets something back, like with that charitable remainder trust, or I'm going to talk about charitable gift annuities, and then the charitable benefits coming at a later point in time. So we're going to just jump 2 slides, Alan. We won't belabor, and I'm going to hit the high points. I do want to note one thing, and it's my red stuff. Working with clients that have not a charitable bone in their body, you know, while everybody thinks, oh, people give for the tax benefits, that is not even, and believe it or not, they've done lots of studies, that's not even in the top 10. Yes, it can help. It can help you give at a earlier time or more, but it's not. So you do need to make sure and explore with clients, are they already supporting charitable causes? So go ahead, and we're gonna just, I'm gonna show you my list, and then we're gonna jump through some of these because we've kind of talked about in the other one. So all sorts of different ways to make a gift that is good for the donor from a tax planning, tax savings, and good for charity as well. So we'll go on to the next one, and we've talked about this already, but not going to beat a dead horse. But if a donor, one of your clients, has appreciated stock, real estate, whatever, and the same amount of cash, they should be gifting that appreciated asset, because they not only have the income tax deduction savings, but they also avoid the capital gains. And because it's going to a tax exempt entity, when the charity sells that appreciated asset, it needs to be owned by the charity by that time, and none of the, too late, because the, sale of the business is already in the works. But assuming that when the charity sells it, the charity recognizes gain but owes no tax on it because they're exempt. And so the full amount is available for philanthropic purposes. Okay, next slide. And who works, obviously anyone that has appreciated assets, you've got to concentrate it. One of your clients has a concentrated position in a particular stock, want to reduce the size of their taxable estate. I've already mentioned, although many cases, in the case of a, for instance, commercial real estate or investment real estate, they may want that cash flow. So maybe an outright gift or to a donor advised fund. But once again, lots of different folks that might work for. Okay, next slide. Qualified charitable distributions, really great way for folks who do not need, and it's direct gift to charity during life of cash out of their IRA. Now the donor IRA owner has to be at least 70 and a half, but when they changed the the age to start taking your required minimum age, they did not change that for the QCD, so it's still 70 and a half. There is a limitation on the amount each year. It is now going to be adjusted for inflation this year, so it was 100,000. It bumped up this year to 105,000. And it can be outright to charity, to an endowment or a field of interest fund, but you can't do a QCD into your DAP, donor advised fund, or to a private foundation. Another reason not to do a private foundation. But anyway, and the full amount of that direct gift out of IRA directly to the charity is not included in the IRA owner's taxable income. So it keeps the taxable income, but it does count for those that have to take a required minimum distribution. It counts as all or a portion of their required minimum distribution. And while folks are looking at their required minimum distribution, when they could gift more than their required minimum distribution up to the limitation, just always like to note that. Now you don't get a charitable deduction for that, but you've moved that income, out of the IRA money, IRA distribution out of your income, and counted that. So you do get tax savings just in a different way than taking a charitable income tax deduction. So next is, who might this work with? It works with folks that are looking for strategies to reduce or keep down their taxable income, to keep their Medicare premiums low, and those kinds of things. Those that don't need their required minimum distribution to cover their living expenses, folks that can't itemize. Their other deductions aren't enough to get them over the standard deduction, but they don't need that income. And so this is a way to keep that out of their income and obviously count, still as part of doing their required minimum distribution. And folks that adding that RMD every year to your estate just grows your taxable estate if you don't need it. So next idea. We've talked a lot about donor advised funds, so we'll just skip through because we've talked about a lot of ways that can work, and donor advised fund. Charitable gift annuities. I will tell you a funny story. About a year or two after I got into private practice, so this would have been 83, 84, I had really great estate planning clients of mine come in and say they had been talking to a charity about this thing called a charitable gift annuity. And, you know, they said, oh yeah, it's this contract where we make a gift and the charity agrees to pay us a fixed, never changing amount for the rest of our lives, no matter what happens with our gift. We can't outlive these annuity payments. The annuity payments are backed by the charity's resources. We get a tax deduction equal to the present value of the charity's future interest, and a portion of the annuity payments is tax-free. And I'm like, this is a scam. This does not, and it was a really major nonprofit. So I'm like, gosh, I thought these were, you know, more on the up and up. Anyway, these are fabulous ways for folks to give. And the hoot is the payout rates that most nonprofits use are those promulgated by the American Council on Gift Annuities. Let's roll forward to the year 2000. I went on the board of the American Council on Gift Annuities and was on it for 20 years. So I love to tell that story, but they're just a great way. So who might a charitable gift annuity work for? That's, excuse me, Alan, the next slide. Individuals and couples that are 70 or older, just because the payout rates increase as you get older, and you know, folks that like a fixed income, and that usually if you're younger, you want something that's more varied. You have highly appreciated low yielding investments, and once again, if there's a need to diversify that portfolio but keep that income, this is a way to do it. Other folks, now in this case, when you're setting up a gift annuity for that someone else is going to be the annuitant, it only can use cash to do that. If you use appreciated stock, you're going to be recognizing all the capital gain in the year you make that gift. But if you've got an elderly client with an elderly relative that they've been providing some financial support for and they're charitably inclined, this might be a way to set up, you know, some financial support that at the elderly relative's death, it goes on to charity. Another option is, and we've had several donors here that create gift annuities to provide retirement support for longtime domestic employees. Or there's a deferred gift annuity where you make the gift now, you get the tax deduction now, but you provide that the payout, the annuity payments to you won't happen until a later point in time. So that's a great option for folks that have maxed out their contributions to their retirement plans.
What's the rationale for supporting an elderly relative or a longtime domestic employee? Because they're in a lower tax bracket?
Yes, yes. And it's just a way to say thank you, especially in the domestic employee. That's why these donors that have done this with us did it. And actually we have a donor who set up something for his sister, not, you know, just a few years difference in age, but she had become disabled, but not enough to, you know, get government benefits, and he wanted to provide for some of her support and was charitably inclined. So that's, you know, that's kind of why you might do that.
Okay, so if I give you my $1 million building, I get an annuity back that typically, if I had paid $500,000 to a commercial annuity carrier, that's pretty much the payment you're going to give me, about half, but I'm going to get an income tax deduction and never have to pay recaptured tax, and I get to feel good.
Right.
Are these ever negotiable where the charity will pay more than 50% of the going rate?
No. Well, some charities do that. We do not, and American Council on Gift Annuities definitely recommends these are maximum suggested rates. Sometimes, you know, and in my nonprofit work in Kentucky, we had one of our educational institutions that we were connected with. Their president was great when it was these really high interest CD interest yields, in talking folks down to a little bit less of an annuity payment. But it's just, those payout rates are, you know, actuarially determined with some fairly conservative assumptions, but it just, you're going to run out of money, and then it's going to be coming out of the nonprofit's going to run out of money, and those payments are going to be coming out of their pocket. So I don't, you know, and that was the point of the American Council on Gift Annuities being formed in 1927, is because it was the Wild West, and this charity is offering this payment rate and this charity is offering that, and there was no giving for desire to support this organization. Is because they were going to pay me more than the other one.
Got it. Okay.
Okay. And then I'm going to quickly hit this one. There is, as the Secure Act 2, one of the things that it added was the ability, very limited ability, to fund a gift annuity or even a charitable remainder trust with a limited amount out of your IRA. You're still 70.5. It's a one-time ever right now opportunity. Maximum for this year is $53,000. It does count as part of your full QCD for that year. But the full amount gets out of your income, and not just the charitable remainder, if you will, present value of the charitable. It counts as a required minimum distribution, just like with a regular QCD, no charitable deduction. But unlike charitable gift annuities, where there's generally that annuity payment back to you, a portion of it is tax-free return of principal, and the rest is ordinary income, or if you use appreciated assets, ordinary income, capital gains, and tax-free. 100% of the annuity payments back each year from the get-go are ordinary income. But it's a way, and we'll go to the next one very quickly, it's a way to you know, set up something you don't want to give. Yeah, next slide, if we can.
By the way, Lori, I'm going to give you an extra 5 or 7 minutes because I've taken a lot of time. So just relax. I want to mention 53,000 to a lot of people isn't a lot of money, but for a married couple, it's 106.
Yes, you could, because if both of them own an IRA, yes, you can. Thank you, Alan. Yeah. Now, no one in their right mind would do even $106,000 charitable remainder trust. Well, maybe they would, but anyway, haven't found any takers on that. But we've had a number of folks do a QCD to fund a gift annuity.
It makes perfect sense to defer. Yes. The deferral of income tax on 106,000 is, you know, more than the price of lunch. That's for sure.
Exactly. So once again, just like with a gift annuity or others, just a standard QCD, reducing taxable income, don't need that required minimum distribution, want to give future support to charity, but also like that life income, because just some, even though it's all ordinary income, it's going to probably be less and than your RMD. So it's still, in many cases, can be a good thing. You just have to kind of run the numbers. Okay, next one.
QCD stands for Qualified Charitable Distribution.
Yes, yes.
Okay.
So I talked a lot about charitable remainder trust, but just quickly, it's an irrevocable trust into which assets are gifted for charitable giving purposes. The trust provides an income, if you will, stream back to the donor and or others. Charitable remainder annuity trust is a fixed, never changing payment. No matter how the assets of the trust grows, it stays the same payment from the start period. The payment amount is the designated percentage in the CRT agreement under the tax law, at least 5% payout rate, times the original value of what is gifted into that CRAT. With the charitable remainder trust, it's that designated payment rate that is in the trust agreement times the value of the assets in the trust as revalued as of January 1st each year. So if invested well, the hope is that it will grow so that those payments out to the donor or other non-charitable beneficiaries will grow over time. I've already mentioned the flip CRUP, which is, once again, sets up the trust agreement, has that payout rate for the unitrust amount, but it says until the triggering event, like the sale of the asset gifted into it or some designated date or whatever, all that's going to be paid is the lesser of the net income earned by the assets of the trust, and they can be invested to be low cash yielding assets and growth assets, and and then it flips in the next year. Trust term can be for life or lives of the income beneficiary, non-charitable income beneficiaries, or up to a term of 20 years, and then the remainder goes outright to a charity or to an endowment or other type of fund at the end of the trust term. So some folks here we've explored quite a bit, but we'll look at that. That's the next slide, Alan. Some donor profiles. So needing to diversify portfolio, they've got, kind of one egg is way too big for the basket, so that's a way, but they want to retain that cash flow. And especially if you are, a youngish donor or couple, got investment in real estate. That was my example earlier. Or I've actually worked with donors, and you can use any kind of asset to fund this, is setting up a CRAT that's going to pay out an income stream for a term of years, maybe to a grandchild or child, to cover higher education expenses. So they're charitably inclined. They want to provide some help for those college education expenses, but they'd like to do it in a tax efficient way, and that can be a great way to do that. So just one other idea there.
Nice.
Next slide. And then just one other type of charitable remainder trust is the testamentary CRT. It's kind of become popular thanks to the Secure Act 10-year payout rule for an inherited IRAs for most beneficiaries other than spouse, disabled, or chronically ill, or a beneficiary that is 10 years young, less than 10 years younger than the IRA owner. So testamentary trust is set up. The IRA is gifted. The CRT is tax exempt, so that full amount of that IRA comes in and there's no taxes to have to pay on that. It's invested, and then you can extend out, obviously, the payout over the life of the beneficiary rather than the 10 years. So obviously, next slide profile is folks that don't want to have to, gift to a beneficiary and avoid the payout rule. Maybe they've got a spendthrift child, and the thought of, their $2 million IRA going out in 10 years to them is not an idea. They want to provide that long-term support. And once again, charitably inclined. They want to benefit individuals and charities with their retirement assets.
Lori, do you see many clients make the IRA payable to the child, with the alternate contingent IRA beneficiary being the charitable remainder trust, and then the child can accept it as an inherited IRA or disclaim it into the stretch to take it out over 20 years?
I think that sounds nice. I think that most children are not going to do that, quite frankly. Yeah, I mean, that sounds like a great idea. You might want to present it to your client, but I'm not sure, if they're really wanting to assure this is going to provide support for the rest of their child's lifetime, they know they're a spendthrift, then I think just directing it immediately to the testamentary charitable remainder trust is the better plan, from assuring your client this is what they want is going to happen.
Right. We have provisions we've used a few times where the IRA is payable to a charitable lead. Mm-hmm. I'm sorry, assets are payable to a child who could disclaim to a charitable lead annuity trust, which could disclaim to the charity. So then after the parent's death, the child and the trustees have 9 months to decide, does it go to the child? Does it go to the CLAT? Does it go to charity? But you don't see much of that?
You have a different level of children of clients than I've ever experienced, quite frankly. I tend to see them. And charitable lead trust, another way, it's kind of sort of the opposite of a charitable remainder trust. The charity's interest is up front, getting that income stream, charitable lead annuity trust or unitrust, same fixed payment for annuity trust, variable payment, and then the remainder, the trust agreement directs the remainder either back to the donor at the end of the trust term or to other non-charitable beneficiaries like family. There is, if you are doing a non-charitable, or excuse me, non-grantor lead trust, there is no charitable income tax deduction for making that gift. There is the charitable gift tax deduction for that, but no charitable income tax deduction. You can get a charitable income tax deduction if you set up the grantor lead trust that's going to come back to the donor. But with a grantor income trust, which remember the income, so to speak, is going to charity, not back to your client, the client, the donor, has to report and recognize all the income of the CLAT during the term of the trust. So that may or may not work. You've really got to run the numbers on that. So next slide kind of gives you a quick, just some thoughts about that. Still in high earning years, need a significant tax relief. I had one where some donors, the husband had gotten a huge kind of once in a lifetime big bonus, and they didn't need all that income right now, and they were charitably inclined, but you know, when they retired, they wanted that. So that kind of works there. Want to support some charitable causes without giving up the ability to ultimately pass it. Leveraged. The value of that present value of the remainder interest is a future interest gift to the family members if it's a non-grantor lead trust, but you can play with that payout rate and all that and hopefully leverage so that what ends up going out to the family is a larger or at least equal value to what you put into that, plus you've provided that charitable support.
All right, Lori, let me ask,
yes.
I just have one question.
Sure.
Can you come back on another Saturday and do a deeper dive and maybe just do three case studies? We could issue the case studies a couple of weeks in advance.
Perfect.
And then people who want to see how the things work out, and then maybe you can do the description. I could run some numbers on a state view. Yay. Maybe we do a series, because I really like the way you describe these techniques, because you describe them in a very understandable way. So, and your slides are really good. They cut straight to the point. So is there anything you want to say? Because we can finish.
This is obviously folks that don't want to give up anything now, bequests and beneficiary designations that happen at death. So no, it's great. Alan, I just can't thank you enough. This has been a lot of fun today. Yeah,
you're fantastic. Okay, so what I want to mention is, if you go, Lori, if you'll go to estateview.info, which you see on the top left there,
yes,
it'll call up our Estate View library, and then I'm giving you a free lifetime subscription to the View software. But when you click here for Estate View Video Library, and this is free to everybody, you don't have to pay to see the Estate View Video Library. The library has a video on how we run the numbers on charitable lead annuity trusts, charitable remainder annuity trusts, charitable remainder unit trusts, and NIMCRUTs, donation of a life estate, minimum distributions are in there. Required minimum distribution calculator will also show you the qualified charitable distribution use within that calculator. And you know, I just hope that people who saw this webinar go to estateview.info, find our video library, and watch some of these videos. I filmed a lot of them. Brandon Ketron filmed some. Joey Kleiner filmed some. And if anyone wants a test subscription to Estate View or a discount on Estate View, just send me an email, agassman@gassmanpa.com, and we can provide that. So, and I want to thank Jonathan Blottmacher, Jerry Hesch, and Bob Keebler for putting up with me long enough to finish out estate view. Lori, any final questions?
No. My email is on the cover slide. Reach out any way I can help. I am glad. I'm not trying to take business, Alan, but if you've got clients you're working with that are exploring a charitable remainder trust, charitable gift annuity, retained life interest gift, whatever, I'm glad. No obligation. It doesn't have to be coming to Community Foundation to run we have the PG Calc charitable gift calculation software, and I'm glad to do that for anyone at any time.
Okay, fantastic. Well, thanks again. As I said, your passion for this, your knowledge, your dedication are really unparalleled. So
Thanks.
very much appreciated. I hope everybody enjoyed this presentation as much as I did. Have a fantastic rest of your Saturday. Thanks again.
Thanks so much.
All right.
Very good. Well, thanks again, Alan. I really appreciate it.
My pleasure.
Bye-bye.
Bye. Stop.